Hello, everybody. So one of the stocks that I've discovered recently is Planet Labs. I don't know if you've heard of it, but Planet Labs is one of the few satellite companies that sell subscription to image services. And they have satellites that fly around the world, take pictures, and you can get multiple pictures daily of the same spot. Their mission is to image the whole world every day and make global change visible, accessible, and actionable. And they are trying to pitch themselves to Wall Street in the latest annual report by telling us that they are the Bloomberg Terminal for Earth data. Try to talk to the finance people, because as you'll see, this stock has gotten no love from Wall Street. It's a very interesting company, actually. Spent quite a bit of time looking at it today. I'm considering doing a full analysis. Let me know in the comment if you think it's a good idea to do a full analysis on that stock. But when I go on the website, I learn a few things about the stock. They have about 200 satellites in orbit. They've deployed a total of 462 satellites, but they retire some satellites, they lose some due to space debris. There's a whole bunch of things in that space that go on. You really have to be an expert in the space, but they have around 200 satellites. The way they make money is they have subscription services. So they sell their imagery services to different companies, administration, institution, non-profits. A lot of people buy those images from them. They actually have more than 30% of their business coming from government, which I believe is a good thing, because it's fairly safe. And they have, of course, an API, and their API helps them connect through a bunch of other tools. One of the things that they do, for example, is they analyze fields, they do forestry, they do competitive surveillance. They can do a lot of things with satellite data. Like, for example, one thing you can do is you can look at parking lots and measure how many cars are on the parking lots of your competition. That's an example. Of course, many applications of all kinds. They have 34,000 users, 700 customers. That's a lot of people. The company is growing very fast. And interestingly, if you go on planet.com or if you watch the news, a lot of their imagery is being used by the news. Like for example, when there was a balloon flying over the United States, they provided a lot of pictures for that balloon. In Turkey, when there was an earthquake, they provided a lot of picture over there. So they end up in the media actually more than you'd think, which I think is very interesting. But like I said, the Bloomberg Terminal for Earth data is desperately trying to get some love from Wall Street. Wall Street does not like the future right now. And look at that SPAC. That SPAC must be down close to 70s. It's a bit, almost 70% down compared to the $10 IPO price. The poor stock got killed, trading at about $4 right now compared to the 10. Yet, the market is crazy, because clearly this company that has existed since 2010 has sales, has a business model, and has some very, very, very serious backers. Like, okay, BlackRock oftentimes invests money on behalf of others, so you can't read too much into BlackRock, because BlackRock invests in everything. But Google does not. Google does not invest in everything. And Google invested in that, which I think is very interesting. And Marc, Benioff, founder of Salesforce, is also a very savvy businessman, and they're both backing this company. So again, this is pretty interesting stuff. But let me look at the data, because on this channel I focus a lot on the numbers. What are the numbers? How does that stock rank in my spreadsheet? Well, it would rank pretty well. It will almost make it to the top 5 at an enterprise value over trailing 12-month gross profit of 8, which is almost twice as little as my average. More than twice as cheap, just about twice as cheap for the enterprise value over 4 gross profit, and significantly cheaper growth. You're paying each percentage point of growth on this company. You are paying very little for it at 0.21 versus 0.57. If you're used to my spreadsheet, you can probably recognize the numbers here. I use enterprise value because I like to penalize companies that have a lot of debt, and this is a company that has nearly no debt. Forward revenue growth is expected to be 38%. Which is excellent. And the gross margin at let's round it up to 50%. At 50%, it's I'd rather it be higher for a subscription service, but I think with time gross margins tend to go up, although it's an expensive product, an expensive service. But let's look a little bit more at the numbers. This is a company that's losing money. And so when a company that loses money, what's important to me is what's the cash burn? The company is still in high growth mode and they're still developing the product. So what's the cash burn? Cash burn is $24 million cash burn over the past 12 months. But look at this. Their net cash position is $387 million. That means they barely spent the SPAC money. They barely spent it because the SPAC brought $434 million. So this is a company that's clearly managed for the long run. They haven't been frivolous with their spending. They've been holding on and hoarding their cash to execute their long-term vision. And in fact, when you divide the cash burn by the cash position, you get a time to bankruptcy of 16 years. So there's nowhere near bankruptcy. I would argue, to me, when I look at this stock, I would look at them at very safe, even though they have some negative cash flow right now. I would consider them fairly safe, especially given the growth rate, given the 38% growth rate, which is pretty high. But here's what I love the most about Planet Labs, which is they went ahead, took a risk, and gave us long-term guidance. And I love long-term guidance on this channel because it removes so much uncertainty. And they've guided for adjusted EBITDA, right? And for a company that has almost no debt like them, it's going to be fairly close to cash flow by early 2025. So Mr. Market cares a lot about that. I personally don't. I care more about the fact cash burn and cash position. Are you going to run out of money or not? That's what I care about. Mr. Market likes to see some adjusted EBITDA, so why not? But what does not lie, in my view, financiers, CEOs, they can put forward any metric that way they want to make their business look good. What doesn't lie is revenue. Sales do not lie, and this company is not only growing sales, but it's given us an outstanding sales prediction. They are guiding $700 million in revenue by early 2026. So for the sake of simplicity, I'm saying this is 3 years from now. It's like 2 years and 9 months. But for the sake of simplicity, I'm saying it's 3 years from now. At the current very depressed valuation of 5.78. Keep in mind, this is a high-tech company in a very high-tech space. You have a mix of software and satellite. This is not a retailer, right? This is a highly complex company. So I believe the price-sales ratio is very depressed on this at a 5.7. So you do 5.7 times 700, very much basic analysis, back of a napkin analysis, you get to a $4 billion. I do believe that the price-to-sales ratio for a company like Planet Labs right now is low, as evidenced by the SPAC selling off. When you look at this pattern, and take any other SPAC, many of which I've covered on the channel, and you'll see the pattern is just the same. The pattern is just the same. The market is throwing the baby out of the bathwater. Like all of these stock patterns look the same. It's like, SPAC equals bad, market sells off, which is crazy because this company is not going bankrupt. This company is not going bankrupt anytime soon, per my look, per what I see. So if you believe the guide, and if you believe in the CEO, and that would be something, right? My confidence in the guide would be something that I would establish after a full analysis, after listening to a few conference calls, very deep research before you can actually say, okay, I trust that CEO. But if you trust the CEO on the $700 million in sales in 2026, this is food for thought. This is something that you can meditate about. If they reach $700 million in sales by early 2026, keep in mind, they almost have $200 million right now. So if they reach $700 million and the price to sales stays the same, no increase in the price to sales price, even though I believe the price to sales price should go up for this company, the ratio should go up for this company. So you assume the same depressed valuation just for sales, right? You would have a 4x return, obviously, right? 1 billion, 4 billion, that's 4x. But if you annualize that, that's a 59% annualized rate of return if you annualize that over a 3-year period. So this is one of the rare companies where I'm getting a number that is what I'm going to call Tesla-esque or Tesla-like or Enphase-like. The other company that I got even this close was actually Cloudflare. So isn't that interesting? This guide, I would have to look more into this guide and look whether it's something that they repeated over and over and over again in the calls. I would have to look at that. But if that is the goal, in my view, this business is a steal, and I just need more time in my life to provide a full analysis for the channel. Let me know in the comment section if you're interested. If you like the content, please like the video. It really helps me out. Please subscribe if you haven't done so. It takes me a lot of time to do all of this. So thank you all for your time. Not investment advice, as always, just entertainment. Appreciate your likes and subscribes. Have a great day.